Good afternoon, everyone, and thank you for taking the time to join us for this presentation on ESB's interim results for H1 2024. Firstly, to introduce the ESB team who will be presenting today, I am Paul, CFO of the group. Rochelle is our current Investor Relations and Credit Rating Manager and will be handing over that role to Liz O'Regan in the coming weeks. Today's presentation will cover a number of topics, including a strategy and sustainability update, followed by an update on our financial results and in our funding and liquidity position. To start, slide 6 summarises ESB's H1 2024 highlights. There's quite a lot of detail in these numbers that we will cover throughout the presentation, but I want to focus on two numbers in particular here to help set the context: operating profit and CapEx. H1 24 saw the continued normalisation of global energy markets and a significant softening of wholesale market prices from the peaks experienced in 2022 and early 2023. In that context, ESB has achieved robust financial results and in line with our board-approved internal targets for the first half of 2024. Our operating profit of 446 million is lower than H1 23 by about 34%, and this reduction primarily relates to generation margins in both the SEM market and our GB market. And this is partly offset by higher revenues earned in both of our networks businesses. In relation to capital investment, ESB continued to invest at scale in energy infrastructure, with 839 million of capital investment, including shareholder loans, during the first half of 2024. This included a 13% increase in investment in the electricity networks on the island of Ireland compared to the same period in 2023. We will talk more about the exceptional item, net debt, gearing, and liquidity further in the presentation, but at the outset, I would like to highlight that these results provide the basis for continued strong investment in a more sustainable and resilient energy future while maintaining our financial strength, and that is very much consistent with ESB's strategic ambition to achieve net zero by 2040. Our strategy, driven to make a difference net zero by 2040, is anchored in our ambition to provide a sustainable and reliable energy system, working to enable the customers and communities we serve to achieve net zero. There are three core pillars to this strategy: decarbonised electricity, resilient infrastructure, and empowered customers. And I will briefly outline some of the key achievements from the first half of 24 in delivering each of these. In relation to decarbonised electricity, H1 24 saw a number of important milestones being reached, including having over 6 gigawatts of grid-scale renewables and 100,000 rooftop solar microgenerators connected to our network. There is now over 1 gigawatt of solar generation connected to Ireland's electricity network also. In relation to ESB's own renewable assets, H1 24 saw significant progress in this space, including the successful energisation of our first grid-scale solar farm at Timoho North in County Kildare. And we expect that project to reach commercial operation before the end of the year. A number of our new renewable projects were also successful in the recent RES4 and AR6 auctions, showing further progress on our target to achieve 5 gigawatts of renewables by 2030. And as part of our research into potential zero-carbon fuels for dispatchable generation into the future, H124 saw ESB launch 2 new zero-carbon hydrogen power generation units. And these were to showcase the first deployment of hydrogen to zero-carbon electricity in Ireland. These HPUs were successfully deployed in a number of demonstration use cases, including to energise the recent TV broadcasting of the Amgen Irish Open Golf Tournament. This initiative showcased the capabilities of hydrogen fuel cell technology, which could be used within Ireland's diverse energy framework. And in relation to a resilient infrastructure, in H124, ESB Networks and NIE Networks in aggregate invested nearly €600 million to meet renewable connection targets, to service demand growth, to upgrade and expand the networks, and to prepare for the widespread adoption of electric transport and heating. ESB Networks have now connected over 1 gigawatt of energy storage to Ireland's network, and a further 2 ESB-owned battery projects at Ahada and Ringsend are nearing commercial operation. And significant progress was also made in H124 in empowering and enabling our customers to achieve net zero. ESB Networks continued the rollout of smart meters, passing the 1.75 million metres milestone mark during the period. As well as committing ESB to achieve net zero greenhouse gas emissions by 2040, our strategy also commits ESB to step forward on social and environmental responsibility. 2024 has seen significant change and progress in the area of sustainability, and I want to highlight 3 of those in particular today. Firstly, our organisation structure has been updated with the appointment of Sharon McManus as our new Group Head of Sustainability, and Sharon joined ESB in April of this year. We've also made significant progress in embedding a new sustainability structure in the organisation, including the appointment of new sustainability managers in each of our business units. This builds on the work we have been undertaking through our STEP programme to build the capabilities needed to deliver on our sustainability ambitions, integrate sustainability into the way we work, and critically to deliver reporting against CSRD and other sustainability standards. The second area I want to call out is the publication earlier this year of our Net Zero Pathway Report. This report presents ESB's roadmap to reach net zero by 2040, along with intermediate reduction targets to 2030 and some strategic performance initiatives to realise our goal. The report also sets out the initiatives being undertaken by ESB to help wider society to decarbonise. Our pathway to net zero is fully integrated into our business plans and represents a 60% reduction in our core Scope 1 and Scope 2 emissions by 2030. That's compared to 2022 levels, and a 44% total emissions reduction when taking Scope 3 emissions into account. Finally, earlier this year, we also published our Sustainability Leadership Plan, and this outlines how we can achieve the milestones in the Net Zero Pathway Report in a sustainable way, including in areas such as biodiversity net gain, climate action, mitigation and adaptation, responsible resourcing through the supply chain, responsible design, and applying circular economy principles in all that we do. And more information on our sustainability targets, ambitions and achievements can be found on our website. I will now hand you over to Rochelle to bring you through some of the financial information.
Before discussing the financial results, I'd like to discuss the operating environment in which we operated in for the first half of 2024, specifically looking at wholesale gas prices, as wholesale gas prices determine the wholesale price of electricity, which have a significant impact on the margins in our generation business. Looking at the first half of 2024, wholesale prices are significantly reduced and a lot more stable compared to prices over the previous 18 months. Wholesale prices are about 32% lower on average in the first half of 2024 compared with the same period in 2023. This reduction in prices, although anticipated, had a significant impact on our business and financial results when compared with the first half of 2023. Electricity demand was strong year to date, being 2% higher than this time last year. So moving on to our financial results, this slide looks at the trend of 4 of our key financial metrics over the last few years. On the top left-hand side of the chart, we look at group EBITDA. While profits and EBITDA are down compared to our exceptionally strong H1 results in 2023, EBITDA is higher than any other year prior to 2023. This reduction was anticipated, and H1 2024 results are very much in line with budgets and forecasts for the year. The top right-hand side of the slide looks at the trend of CapEx spend, which is growing year on year. These figures exclude shareholder loans to joint venture renewable projects, which amounted to about 88 million in 2024 year to date. Our total capital investment is up slightly on last year, and we expect further growth in this over the second half of the year. In line with our published 5-year plan, we expect EBITDA and CapEx to continue to grow over the coming years, with an average CapEx spend of between 2 and 2.2 billion per annum, as we invest in the infrastructure required to deliver on our net zero ambitions. Based on these figures, we are and will continue to invest €2 for every €1 of operating profit we generate, with a significant portion of this capital investment spend being funded through borrowings. Net debt is up 300 million compared to 2023 year end, reflecting CapEx spend during the year and a lower cash balance compared to December 2023. Gearing percentage of 53% at the end of June has increased since December 2023, reflecting higher net debt. Next, I'll give you an overview of the ESB Networks business, which comprises 48% of group EBITDA and 51% of group assets. The Regulatory Price Review Period 5, or PR5, is currently in its 4th year, and ESB Networks has continued to make solid progress on the approved investment and maintenance programmes. ESB Networks' operating profit of 174 million is up 17 million compared to the same period in 2023, and this is primarily due to higher regulated income. CapEx at 471 million is up 58 million or 14% on the same period in 2023 due to the continuing increased investment in the distribution and transmission networks as well as the smart metering programme. The remainder of 2024 will see Networks continue the implementation of the PR5 contract and commence engagement with the CRU on the next price review, running from January 26 to December 2030 and will be known as PR6. Earlier this year, the CRU published a strategy paper for PR6, which aligns with the government's Climate Action Plan 2024 and ESB's own Networks for Net Zero strategy, and it recognised the need for increased network spend in the price review period. The expected timeline for the PR6 process is outlined above. ESB Networks hopes to submit their business plans at the end of October 2024, with a final determination on PR6 being issued by the CRU in Q3 2025. This slide gives an overview of our other regulated business, NIE Networks. NIE Networks comprises 15% of group EBITDA and 16% of group assets. NIE's operating profit of 55 million is 45 million higher than the same period in 23 due to higher regulated income, reflecting NIE Networks' continued investment in key electricity network infrastructure, coupled with increases for inflation in the current year and the delayed recovery of higher allowed costs due to inflation from prior years. NIE Networks' capital expenditure of 121 million is up 11 million compared to the same period last year and reflects an increase in the work programmes as part of NIE Networks' RP6 plans. The utility regulator determined in March 23 to extend the duration of NIE Networks' current price control period, RP6, by 1 year, moving the end date of RP6 to the 31st of March 2025. Consequently, the RP7 price control period has been deferred and will now commence in April 2025 and run to March 2031. NIE Networks has continued to focus on implementing its RP6 plan. NIE Networks submitted its ambitious RP7 business plan to the utility regulator in March 23, outlining its proposed expenditure for the next price control period, an increase of over 80% on RP6 spend. NIE Networks' plan will support and enable Northern Ireland's journey towards net zero by facilitating decarbonisation of the electricity system. A final determination on RP7 is expected from the utility regulator in the coming weeks. ESB's generation and trading business contributed about 34% of group EBITDA and made up 22% of group assets at the end of June 2024. G&T's operating profit of 227 million is down 267 million compared to the same period last year, mainly due to lower energy margins as a result of wholesale market price reductions from the levels seen in late 2022 and early 2023, as we discussed earlier. These movements, although expected, have impacted the margins earned across ESB's thermal and renewable generation portfolio in both Ireland and in the UK. An exceptional provision of 135 million has been recognised at the end of June 2024 related to the Nartnaguiha offshore wind project, a joint venture development with EDF Renewables off the east coast of Scotland. The charge arises as a result of delays to the construction programme experienced during 2024. We remain confident, however, that the project will achieve full commercial operation in 2025 and will be a valuable asset for ESB, as well as reducing carbon emissions from electricity generation over the longer term. ESB's generation fleet has a diversified fuel mix, with renewables making up 21% of our generation output year to date, up from 20% in 2023. Emissions from electricity generation continued to fall in the first half of 2024 and are reduced from our 2023 levels, making progress to reach our target of 140 grams of CO2 a kilowatt hour by 2030. Capital expenditure in generation and trading at 127 million reflects continuing investment in the existing generation fleet and new renewable projects. In addition, generation and trading invested 88 million by way of shareholder loans to joint venture projects for the period ended June 24. The majority of which related to ESB's continued investment in offshore wind and solar power projects. This brings total capital investment in the generation business to 215 million in the first half of 2024, and we expect this figure to grow in the second half of the year. 62% of total generation investment in the first half of 2024 was spent on renewable or renewable enabling assets. Our renewable pipeline continues to grow, with over 12 gigawatts of renewable projects identified. At the end of June 2024, ESB has 1.4 gigawatts of installed renewable or renewable enabling assets, with a further 1.7 gigawatts of renewable assets either under construction or awarded contracts in recent auctions. These projects will significantly contribute towards our target of having 5 gigawatts of our installed renewable capacity and 63% of our output coming from zero carbon sources by 2030. Customer Solution includes ESB's customer-facing businesses involved in the supply of electricity, gas, smart energy services, wholesale telecom services and e-transport. Its Electric Ireland business is the leading supplier of electricity, gas and energy services in Ireland, with 39% market share and over 1.5 million customer accounts at the end of June 2024. Given the volatility in wholesale energy market prices, resulting in significantly higher energy costs, the last 2 years have been particularly challenging for customers. Maintaining a strong connection and supporting customers remained a key focus for Customer Solutions across all its businesses this year. Customer Solutions operating profit of 17 million is 6 million lower than the same period in 23 due to reduced margins and higher operating expenditure in Electric Ireland. This was somewhat offset by an improved performance in So Energy, our retail business in Great Britain, for the first 6 months of the year versus the same period in 2023. I'll now pass you over to Liz, who will take you through an update on funding and liquidity.
Thanks, Rochelle. This slide provides an overview of ESB's debt position, which stood at €7.4 billion at the end of June 2024, down from €7.7 billion at the end of 2023, as a result of the repayment of a €300 million bond in January 2024. The weighted average interest rate on the group's portfolio of outstanding borrowings at the 30th of June 2024 is 3.1%. This is unchanged from December 2023. 84% of group borrowings are fixed to maturity, 9% inflation linked, and 7% variable rate debt. A breakdown of our debt structure is outlined in the chart on the left-hand side of the page. You will note that approximately 23% of group borrowings are sterling denominated, with the remaining borrowings in euro. These sterling borrowings have been raised to fund assets in Great Britain and Northern Ireland, which earn or will earn in the future sterling denominated net revenues. ESB continues to explore a range of options for future debt issuances. The pie chart on the right-hand side of the slide illustrates that we had a strong liquidity position at the end of June of €2.2 billion. A €1.4 billion sustainability-linked revolving credit facility is in place with a group of 13 international banks. This facility currently extends to February 2027 and was undrawn at the 30th of June 2024. The cost of this standby liquidity facility is directly linked to the delivery by ESB of Pacific decarbonisation targets aligned with ESB's strategy. In June 2024, an additional revolving credit facility of €750 million was not renewed, as our current liquidity is significantly in excess of scheduled debt repayments due over the next 24 months of circa €1 billion. This slide gives an overview of ESB's debt repayment profile out to 2035 and beyond. In the context of ESB's ongoing EBITDA performance, averaging €1.6 billion per annum in recent years, and liquidity of €2.2 billion, ESB's debt maturity profile is considered manageable. We continue to proactively manage borrowings, repayment profile, and maintaining the ability to fund in the future through close ongoing engagement with our banks, debt investors and credit rating agencies. ESB has credit ratings of A- from S&P Global Ratings and A3 from Moody's, which includes a one-notch uplift for the sovereign rating. S&P reaffirmed this rating with a stable outlook in 2024, while Moody's changed the outlook on ESB's rating from stable to positive in August 2024. The main driver of this change follows Moody's change of outlook on the AA3 rating of the Government of Ireland from stable to positive, which was also announced in August 2024. You will note some of the credit strengths the rating agencies called out in their latest reports include the high proportion of projected EBITDA from regulated or quasi-regulated income, as well as their consistently strong financial metrics to date. It is our intention to maintain a credit rating of BBB+ on a standalone basis out to 2040. I will now hand you back to Paul. Thank you.
That brings an end to our presentation today. In summary, H1 2024 has seen a reduction in operating profit compared to last year, but that reduction was anticipated due to the fall in wholesale energy prices, and we are performing very much in line with budget. CapEx spend is up 13% across our networks businesses, reflecting positive progress in delivering against their respective price controls. And we anticipate CapEx spend will increase again in the second half of the year, especially in the generation business, and for full year CapEx to be higher than last year. Slide 22 is a reminder of our key credit strengths, and contact details for any follow-up queries are included in slide 23. We look forward to engaging with our investors to discuss this presentation in more detail. Thank you for listening.